Ever feel like you're just drowning in information, especially when you're trying to understand, these really complex industries that affect us all?
Oh, absolutely. It's overwhelming.
It is, isn't it? Trying to cut through all that noise
Yeah.
and really get a handle on what's actually happening, the real forces at play.
Yeah, the why behind it all.
Exactly. Well, that's what we try to do here on the Deep Dive. We aim to give you that shortcut, basically, to being well-informed. We pull out the most important stuff, the key insights, so you get it without getting totally bogged down.
That's the goal, definitely. Helping connect the dots, providing that context so you understand not just what's going on, but why, and maybe crucially, what it could mean for you.
And today, we are jumping right into a world that's, well, it's fascinating, but also, let's be honest, often pretty turbulent.
Uh-huh.
We're talking about the property and casualty insurance market down in Florida, and we're going to look at it through the lens of one specific company, HCI Group, Inc.
Right. A major player there.
But this isn't just going to be about numbers on a spreadsheet. Not at all. This is really a story. It's about huge legislative changes, about these global market cycles that ripple outwards, about tech innovation being used as a real strategic tool.
And that constant tension, right, between the company needing to be profitable and people needing affordable insurance, especially in a place like Florida that sees so many catastrophes.
Exactly. That tension is key.
And what's really interesting here is seeing how all these pieces fit together. It creates this narrative of resilience, adaptation. You've got a company like HCI trying to navigate these massive forces. Their story is almost like a perfect case study for the whole market.
It really is. A story of big changes, big adaptation.
Yeah, a dramatic shift, really.
So our mission today is to unpack HCI's journey, and through that, get a better grip on the whole Florida insurance scene. We want to explore some big questions. Like, is this stability we're seeing now in Florida, is it real? Is it a structural thing that's going to last, or is it just, a calm patch before the next hurricane season really tests it?
A really critical question.
And does HCI's own tech, their proprietary stuff, does that give them a real lasting edge over the competition?
That's another big one, the tech angle.
How does the global reinsurance market, this huge thing happening often behind the scenes, how does that affect a company focused mainly on Florida like HCI?
Yeah, that connection is often missed, but it's vital.
And putting it all together, what does it all mean for understanding HCI's value and, importantly, the risks that come with investing in this kind of business?
It is a complex picture, no doubt about it. But looking at it gives you these crucial insights into how policy, global capital, local business, how they all react not just to crisis, but also to the reforms that come after.
Right.
I mean, we're talking about a massive swing for HCI. They went from big losses just back in 2022 to projecting record profits in 2024, 2025. That kind of turnaround is pretty rare, and it tells you a lot about the impact of the changes that were made.
So get ready for, I think, some genuinely surprising facts and maybe a few aha moments along the way. Because this isn't just some dry business analysis.
No.
It's a real case study in resilience and adapting, and you really see the powerful ripple effects when major legislation changes things. By the end, you should have a much clearer picture of what makes this market tick and why it matters.
Let's dive in.
Okay, so let's start by setting the scene. Florida's property insurance market. To really get why the recent turnaround is such a big deal, we need to understand just how bad things were before, say, 2022.
Oh, it was bad. Really bad.
It wasn't just struggling, right? It was more like a full-on crisis.
Absolutely. For 8 straight years leading up to 2022, the Florida property and casualty P&C market was just defined by these deep, deep problems. And, it wasn't just about the hurricanes, though obviously they didn't help. It was more fundamental, a breakdown in just how the market was functioning.
A fundamental breakdown. What was at the core of that breakdown? If it wasn't just storms, what was it?
Well, connecting it to the bigger picture, the main issue wasn't really the natural disasters themselves. It was the legal environment. It had become, frankly, deeply problematic. It fostered just excessive litigation.
Excessive litigation.
Yeah. Our sources actually call it a claims cottage industry. Can you picture that?
The claims cottage industry.
Oh.
Wow, that's quite a phrase.
It paints a picture, right? It was like the legal system, maybe unintentionally, had created these really strong financial incentives. It just became super profitable for certain lawyers, certain contractors to file lawsuits, often over really minor stuff or disputed claims.
Instead of just resolving the claims efficiently.
Exactly. It was almost like a machine churning out lawsuits.
So it became more profitable to sue, then for the insurance system to just work as intended, paying legitimate claims.
Whoop.
What were the actual consequences for the insurers, for homeowners?
Well, the consequences were pretty dire and widespread. You had just rampant litigation. You saw an alarming number of insurance companies actually going insolvent, going bust,
Wow.
and just continuous underwriting losses across the board. Lots of insurers just couldn't make money in Florida. So they either pulled out of the state altogether, drastically limited how many policies they'd write, or, like I said, went out of business.
And that instability must have hit homeowners hard.
Oh, directly. Fewer choices for coverage, premiums that were just skyrocketing year after year. And often the coverage itself wasn't as good. It really created this vicious cycle. Rising costs, shrinking availability. It was bad news for everyone.
Okay, so a real crisis situation affecting everybody. But then something big happened, this legislative overhaul between 2022 and 2023. You said it wasn't just tinkering.
No, not tinkering at all. This was a truly structural shift. These weren't just minor adjustments. The legislature held special sessions, which tells you how urgent they thought it was.
Right.
And they passed these sweeping reforms. The whole point was to fundamentally change the state's tort landscape. You know, the whole legal environment around civil claims. They were going right after the roots of that litigation mess.
Okay, let's unpack that, because this sounds like where things really started to turn. What were the key reforms? And maybe more importantly, how did they actually work to fix that litigation problem?
Well, one of the absolute biggest changes was getting rid of something called one-way attorney fees.
One-way attorney fees. Explain that.
Okay, so the old rule was if a homeowner, the plaintiff, sued their insurance company and won in court, even if they only won a tiny amount more than the insurer had offered, the insurance company had to pay all of the plaintiff's legal fees, not just their own, but the other side's too.
Wow. Okay, I can immediately see how that might create some interesting incentives. How did that play out?
Think about it like this. If you're an attorney and you know your fees are basically guaranteed by the insurer if you win anything, it creates this massive incentive to file lawsuits. You could take on cases with pretty small damages, maybe even claims that were a bit shaky, knowing that if you managed to win even a little bit, your payday was covered by the insurer.
So it fueled an explosion of lawsuits.
Exactly. It turned lots of small disputes that maybe could have been settled into really expensive legal battles. It was just draining capital from the insurers. So by repealing that rule for property insurance claims, the legislature basically tried to remove that primary economic driver for excessive litigation, kind of rebalance things.
That makes sense. A huge change to the economics of suing. What else did they do that was really impactful?
Another really significant one was prohibiting assignment of benefits, or AOB.
AOB. I've heard that term. How did that work, and why was it such a problem?
Okay, so under the old system, let's say you're a homeowner, you've got roof damage from a storm, a contractor comes knocking, says, I can fix that. Then they ask you to sign this AOB form. What that did legally was transfer your right to the insurance benefits directly over to the contractor. So the contractor then basically took over the whole claim process.
Ah, so the homeowner was kind of out of the loop.
Often, yeah. And this became a massive source of inflated claims because once the contractor had that AOB, they had the legal power to sue the insurer directly.
I see.
So the incentive for them was to jack up the repair costs, maybe replace the whole roof when only a patch was needed, knowing they could then fight the insurer in court for every penny, often without the homeowner really being involved or even fully understanding what was happening.
Wow, that sounds ripe for abuse.
It really was. So by banning AOBs for new policies starting January 1st, 2023, the goal was to stop those inflated claims and the lawsuits that followed, putting control back with the actual homeowner.
Okay, so fewer third parties driving up costs, more control for the policyholder. Any other big changes to how claims were handled?
Yeah, a couple more important ones. They also significantly shortened the deadlines for filing claims.
How much shorter?
Pretty drastically. It used to be you had 2 years to report a brand new claim and 3 years if it was a supplemental claim, like more damage found later from the same storm.
Okay.
Now is down to 1 year for new claims and only 18 months for supplemental ones.
Why the change? What does that shorter time frame do?
Well, for the insurers, it helps reduce what they call the long tail of uncertainty. Older claims are just harder to investigate accurately, they cost more to handle, and they're more likely to end up in court as memories fade and evidence gets lost.
Makes sense.
And for policyholders, the idea was to encourage faster reporting and faster resolution, less time for things to drag out and potentially turn into a dispute.
Okay. And you mentioned one more.
Yes, reforms to the prompt pay law. These basically tighten the timelines for insurers. They now have less time to acknowledge a claim, investigate it, and then make a decision, either pay it or deny it.
That sounds like it benefits the policyholder, setting clearer expectations.
That was definitely the intention. Improve the process for homeowners by setting stricter standards for the insurers, while also, again, cutting down the time window where claims could just linger and maybe escalate into litigation.
So, summing up these reforms, it really sounds like this wasn't just about hurricane damage. It was laser-focused on controlling that human-made risk, that litigation-heavy environment.
Precisely. It was about rewriting the rules of engagement, like you said earlier.
Taking aim at these structural flaws.
Exactly. The state basically went after the underlying issues that had made the market such a mess for so long, a direct hit on that claims cottage industry.
Okay, now this is where it gets really, really interesting. Let's talk about the impact. We've hinted at this dramatic turnaround from losses to profits. How quickly did things change, and what did the numbers show?
Oh, the turnaround was dramatic and, frankly, pretty stunningly fast. The data is really compelling. Remember those 8 straight years of underwriting losses for the Florida specialist insurers?
Yeah, grim picture.
Well, in 2024, this is excluding the state-run Citizens and the big national carriers. Just looking at the Florida-focused guys, they reported their first underwriting profit in 8 years.
The first one in 8 years. Wow. After all that red ink.
Yeah. Think about that. 8 years, bleeding money, then suddenly, boom, profitability.
What was the most surprising part of that speed? And can you give us some specifics? How big was the swing?
I think the sheer speed was what surprised a lot of people. It really showed just how much that litigation drag was holding things back once that was lifted or at least significantly reduced.
Things snapped back.
They really did. So for specifics, that group of Florida specialist insurers, their combined ratio, remember, under 100 is profitable, was 93.1% in 2024. And they had an underwriting gain of $206.7 million.
Okay, compare that to the year before.
In 2023, they had a $174.4 million loss.
Wow. That's a huge swing. Nearly $400 million difference.
It's massive. And their pre-tax operating income. It surged to $492.3 million in 2024. The year before, it was basically just break even. These aren't small changes. They are truly seismic shifts in financial performance.
Those numbers are incredible. So was it just the reforms that drove this, or was something else boosting profitability too?
That's a really crucial point. The reforms were absolutely the foundation. They made profitability possible again. But the turnaround was also significantly fueled by substantial rate increases that insurers had pushed through during those crisis years.
Right. They'd been losing money, so they had to raise rates just to try and survive.
Exactly. They needed to cover those mounting losses, and those rate hikes were significant. Data from the Florida Office of Insurance Regulation shows the average property insurance premium shot up by 34%.
34%.
Yeah, just between the end of 2022 and early 2025. The average premium hit $3,023.
That's a huge jump for homeowners. A real hit to the wallet. So the total amount of premium money coming into the system must have soared too.
It absolutely did. Over a similar time frame, the total direct premium written by these insurers climbed almost 40%, reaching about $23 billion. So the why behind this sudden profitability is really a powerful combination.
Okay, lay it out.
It's a sharp drop in litigation-driven claims frequency thanks to the reforms,
Right.
combined with significantly higher premiums being earned thanks to those earlier rate hikes. Put those two together and you get what our sources are calling exceptional underwriting profitability.
Okay, that clarifies it. Reforms fixed the leaks, rate hikes filled the bucket. But now the bucket is full, and the market looks stable and profitable.
Right.
What happens next? Does money start flowing in? Because profit usually attracts competition.
You nailed it. That's basic economics. And yes, predictably, restoring stability and profitability acts like a magnet for new capital. The Florida Office of Insurance Regulation, the OIR, they've already noted 15 new P&C companies entering the Florida market since the reforms passed, as of August 2025.
15 new companies already. So competition is definitely heating up. What does that mean for the existing players like HCI? Those record profits might not last forever if new guys are jumping in.
Exactly right. This is where we see what's called a profitability competition lag. Those huge profits in 2024, they're the result of actions taken back in 2022, 2023.
Right, the reforms and rate hikes.
But the reaction from the market, new companies forming, raising money, starting to compete for policies that takes time to fully play out, we'll see the real impact of that competition building through 2025 and beyond.
Okay, so those exceptionally high margins that companies like HCI are enjoying now, they probably have a finite lifespan.
Yeah.
Eventually, more competition means pressure to lower prices, right?
Almost inevitably, it's a cycle. And this leads to another really important point. While the insurance companies are celebrating being back in the black, there's a growing political risk, and that's the affordability crisis for homeowners.
Yeah, that 34% average rate hike is staggering.
Exactly. So you have this stark contrast. Record industry profits on one side, and homeowners struggling with massive premium increases on the other. That's a politically charged situation.
Especially when you see news reports, like that Newsweek story about thousands of Hurricane Debby claims being closed without payment. That adds fuel to the fire, doesn't it?
It absolutely does. That kind of story, combined with the high premiums, creates a really politically sensitive environment. And the implication is huge. If affordability becomes a major political flashpoint,
Which it seems likely to.
it could easily lead to future regulatory intervention. You could see politicians pushing for things like rate caps or maybe even mandating premium reductions.
Which could potentially undo some of the benefits the insurers gain from the reforms.
Precisely. It could unwind some of the benefits, creating a whole new set of challenges. It's a really delicate balancing act for regulators and politicians down there.
That's a critical point. It's not just about market forces. Politics and social pressure can reshape the whole game. Okay, let's shift gears slightly and talk about something huge but often invisible. Reinsurance. You mentioned it's a massive cost. Can you explain what it is and why it's so critical, especially for a Florida insurer like HCI?
Sure. Reinsurance is basically insurance for insurance companies. Simple as that.
Insurance for insurers. Okay.
Think of it as their financial backstop. For a company like HCI, writing policies primarily in Florida, a state hammered by hurricanes, reinsurance is their single largest cost of goods sold. It's how they protect their own finances from a truly devastating hurricane or a series of storms that could otherwise just wipe them out.
So without it, they couldn't really operate in Florida.
Honestly, no. Not prudently, anyway. Without strong reinsurance, a major hurricane could bankrupt them. It's absolutely essential.
Got it. So it's their crucial safety net, but a very expensive one. And I gather the price and availability of this reinsurance isn't stable. It follows some kind of global cycle.
Exactly. It's dictated by a global market cycle, and recently that cycle has been on a real roller coaster. It swung from what felt like a really punishing, expensive, hard market to more recently a much more favorable, capital-rich environment. And that shift provides a significant tailwind for HCI. It helps their bottom line directly by making their biggest expense potentially lower or at least more predictable.
Okay, tell me about that punishing hard market. What happened around 2023 that made it so tough for insurers buying reinsurance?
Well, 2023 was really the peak of it. Some called it the Great Reset. What happened was, after several years of really big catastrophe losses worldwide, not just Florida hurricanes, but wildfires in California, floods in Europe, you name it,
Right.
and generally poor financial returns for the reinsurers themselves, they basically said enough is enough. They needed to get their own houses in order financially. So at the big renewal period on January 1st, 2023, the market went through this historic reset.
A reset. Sounds painful for the buyers.
Yeah.
What did that mean for companies like HCI trying to buy their protection?
Oh, it was definitely a painful correction for them. The reinsurers, needing to boost their own profits, did a few things. They drastically increased prices, sometimes 30, 40, 50% or even more for the same coverage.
Wow.
They also raised the attachment points. That's the level of loss where the reinsurance actually starts paying out. Raising that means the primary insurer, like HCI, has to absorb more of the losses themselves before the reinsurance kicks in.
So they keep more risk.
Exactly. And on top of that, reinsurers tightened up the terms and conditions of the coverage significantly. So insurers like HCI were forced to pay a lot more for protection that often started higher up and might have had more restrictions. It was tough.
Okay, a much harder, more expensive environment. But then you said things shifted again in 2024, 2025.
Yeah.
What turned it around? Why did it become more favorable?
Well, ironically, it was the success of that hard market for the reinsurers. Because prices went up so much, they finally started making good money again in 2023 and 2024.
Ah, success breeds capital.
Precisely. Strong returns attracted a whole lot of new capital back into the global reinsurance market. Aon, one of the big brokers, reported that global reinsurance capital hit a new record high, around $735 billion by mid-2025.
$735 billion? That's a huge pool of money.
Massive. And a growing part of that was alternative capital, things like catastrophe bonds, where investors basically bet on whether catastrophes will happen. That part surged to $121 billion. It showed investors were eager to get back into insurance-linked investments once the pricing was right.
So all this new capital flowing in,
Mm.
more players wanting to sell reinsurance, does that flip it back to being more of a buyer-friendly market for HCI?
Exactly. More capital means more competition among reinsurers. And yes, that shifts the power dynamic. While the reinsurers have tried to maintain discipline on the terms and attachment points, they haven't forgotten the pain. The pricing has definitely softened. We saw property catastrophe programs that didn't have major losses getting rate reductions, maybe 5% to 15%, at the January 2025 renewals. AM Best even said the balance of power appears to be shifting toward primary carriers. Companies like HCI have a bit more leverage now.
Okay, so these are direct tailwinds for HCI. They can buy that essential catastrophe protection at more stable and predictable costs.
Yeah.
That flows right to their bottom line,
Yeah.
improving their net combined ratio and earnings.
Absolutely. Lower reinsurance costs are a direct benefit. And we saw HCI successfully complete its big reinsurance program for 2025-2026 back in June 2025, reflecting this calmer, more competitive market. That's a significant positive for their financial outlook.
But I sense there might be a but coming. Is there a downside to this softening reinsurance market? Does it create other issues?
There absolutely is a double-edged sword here. And this is a crucial point. While cheaper reinsurance is great for HCI's costs, it also lowers what was probably the single biggest barrier to entry for new insurance companies wanting to start up or expand in Florida.
If reinsurance is easier and cheaper to get, it's easier for competitors to jump in.
Exactly. It significantly reduces the financial hurdle. So this softening reinsurance market will likely accelerate the influx of competition into Florida, which in turn could shorten the duration of the supernormal profits that companies like HCI are enjoying right now.
So again, we see that cycle. Good news on costs might mean tougher competition down the road.
Yeah.
It really shows how interconnected everything is in this insurance world.
It really does. Market dynamics are always shifting.
Okay, let's zoom in now on HCI Group itself. We understand the market, the reinsurance cycles. How does HCI fit into all this? What's their core business model and strategy?
Well, HCI is technically a diversified holding company, but let's be clear. Its financial results are overwhelmingly driven by the insurance side of the house.
Got it. Insurance is king.
Definitely. Their strategy is deeply rooted in Florida. They try to leverage their own technology, and they're known for being pretty opportunistic, capitalizing on market disruptions, like other companies pulling back, for example. Essentially, they aim to grow by being smart and efficient in what everyone knows is a really volatile place to do business.
So, not just passively riding the waves, but actively trying to navigate them using tech and strategy. You said it's a holding company. What are the key pieces under that HCI umbrella?
Sure. So first, you have the original carrier, Homeowners Choice Property and Casualty Insurance Company, or HCPCI, founded way back in 2007. This is their core, focusing on homeowners, condo insurance, renters insurance, mainly in Florida. That's the foundation.
Okay, the traditional base. What about newer stuff, especially that tech focus you mentioned?
Right. Then there's TipTap Insurance Company. They launched TipTap in 2016. This is positioned as HCI's technology-focused insurer. It's been a big driver of their organic growth. TipTap uses more modern tech for underwriting, for policy administration. The goal is efficiency, speed, precision, often allowing customers to get quotes and buy policies completely online.
So a traditional carrier and a more modern, tech-driven one. Where does the tech itself come from? Is it bought off the shelf or?
No, and this is key. It comes from Exio. This is HCI's own in-house technology division. Exio develops the proprietary software platforms that both HCPCI and TipTap use.
Like what kind of software?
We're talking about things like their Harmony system, which handles all the policy administration, issuing policies, billing, endorsements, everything. And their Claim Colony platform for managing claims. Having this tech developed in-house is a pretty significant differentiator compared to smaller players who might rely on third-party systems. Gives them more control, more customization.
That sounds like a potentially powerful advantage. Do they have anything else in the group besides insurance and tech? Any diversification?
Yeah, they do have some. There's Greenleaf Capital, which is their real estate subsidiary. Greenleaf owns and manages commercial properties in Florida, office buildings, retail spots, even some marinas. So that provides a bit of diversification away from pure insurance risk.
Okay.
And one more important piece, Clado Casualty Insurance Company. This is a reinsurance company they set up domiciled in Bermuda.
Ah, so they're playing the reinsurance game themselves.
In a way, yes. Clado allows HCI to basically reinsure a portion of its own risk. It gives them more flexibility, lets them keep some of that reinsurance premium within the group, and helps them actively manage their exposure to the ups and downs of that global reinsurance cycle we talked about.
Okay, so quite an ecosystem they've built there. Insurance, tech, real estate, even their own reinsurer. What's been a primary way they've actually grown their insurance business in Florida, especially with all the market turmoil?
A really key part of their growth strategy, especially recently, has been actively participating in Florida's Citizens Depopulation Program.
Citizens.
Yeah,
That's the state-run insurer of last resort, right? The place people go when they can't get private insurance.
exactly. And Florida has been trying for years to shrink Citizens to get policies back into the private market. The depopulation program is how they do that. Private insurers can apply to take out policies from Citizens.
Okay, so it's a way to move policies off the state's books and onto private companies. How does HCI approach that? Do they just take any policy?
No, and this is where their tech comes in again. HCI uses its systems, presumably drawing on lots of data, to analyze the huge portfolio of policies within Citizens. They then selectively choose policies that fit their specific underwriting appetite, maybe policies in areas with lower historical losses or homes built to better standards.
So they cherry pick, essentially.
You could say that. It's proven to be a very effective way for them to acquire a lot of premium relatively quickly and cheaply, especially as the state is actively encouraging this depopulation.
Any examples of the scale?
Yeah, for instance, in the first quarter of 2024, HCI took on about 9,800 policies from Citizens. That represented nearly $88 million in annualized premium right there.
Wow, that's significant growth in one go.
And later in 2024, three of their carriers, HCPCI, TipTap, and another one called Tailrow, were approved to potentially take out up to 25,000 more policies each. So it allows them to scale up rapidly, but in a controlled, selective way.
That really highlights the power of that tech for efficient growth. You keep mentioning the technology Exio. How big a competitive differentiator is that really compared to other local Florida insurers?
It's potentially a major factor. HCI has clearly made a significant ongoing investment in building its own tech through Exio. Management argues pretty strongly that these platforms give them real advantages.
Like what specifically?
More precise underwriting, they claim. Being able to assess risk better, price it more accurately. Greater operational efficiency, meaning lower costs to run the business day to day. And a better claims handling process, which is huge for both cost control and keeping customers happy. In a high-volume, high-risk market like Florida, especially with new competitors coming in, those efficiencies can be critical.
And there's talk about Exio potentially being spun off. What's that about, and why is it considered a big deal?
Yes, this is something the investment community is watching very closely. HCI management has openly stated their intention to eventually establish Exio as its own separate, independent, publicly traded company, maybe through a spinoff to existing HCI shareholders or maybe through an IPO.
Why would they do that? What's the benefit?
Well, there are a few potential big benefits. First, it could unlock value. The market might value Exio much more highly as a pure-play insurtech company than it does when it's just buried inside an insurance holding company.
Really?
Tech companies often get higher valuation multiples. Second, a spinoff or IPO would likely bring in a significant chunk of cash, either for Exio itself to grow or for the parent company, HCI. And third, it creates strategic clarity. You'd have the insurance business and you'd have the tech business clearly separate. That might appeal to different types of investors and make each business easier to understand and value.
Okay, that makes sense. A potentially significant move that could really change the perception and valuation of the whole group. Now, shifting to the people running the show, management and governance, do they have, skin in the game? Are their interests aligned with shareholders?
They definitely do, and this is often seen as a strong positive by investors. HCI has substantial insider ownership. The chairman and CEO, Paresh Patel, beneficially owns about 14.4% of the company's stock.
14.4% is a lot for a CEO.
It is, and the executive officers and directors as a group own nearly 22%. That's a significant chunk, showing strong alignment. Their fortunes are very much tied to the company's success.
That certainly suggests a long-term focus.
Absolutely. And adding to that, the CEO has publicly stated he's never sold any of his shares since the company started. That reinforces a commitment to building long-term value, not just hitting short-term targets. Plus, the board and management team have deep experience in insurance, tech, real estate, and many have been with HCI for a long time, providing that stability and know-how.
Okay, one more piece on the company structure.
Huh.
Financial strength ratings. This seems like a point of difference for HCI. They used Demotech, not AM Best, which most people think of as the gold standard. What's the story there?
Yeah, this is a really important strategic choice common among Florida specialists. HCI's insurance companies, HCPCI and TipTap, have an A exceptional financial stability rating from Demotech Inc.
And that Demotech rating is crucial for.
It's crucial because mortgage lenders in Florida accept it. If your insurer doesn't have a rating accepted by Fannie Mae and Freddie Mac, homeowners basically can't get mortgages on the properties insured by that company. So having that Demotech A is essential just to operate in the state.
Okay, so it meets the minimum requirement. But AM Best is generally seen as tougher, more prestigious, especially by national players. Why not go for an AM Best rating? What's the strategic reason?
It's a calculated decision. AM Best typically imposes more stringent capital requirements. They generally want insurers to hold more capital relative to the risks they take on.
More capital means less risk, but maybe lower returns.
Exactly. By not pursuing an AM Best rating, HCI can operate with a more flexible capital structure. They might hold less capital than AM Best would require for a similar rating level. And holding less capital, all else being equal, can lead to a higher return on equity, especially during profitable times like now, because you're generating profits on a smaller capital base.
So it's a trade-off. Optimize for capital efficiency and potentially higher returns, but maybe you're perceived as having a slightly lower quality rating than the AM Best guys.
That's a fair way to put it. It creates what analysts sometimes call a quality gap compared to the big national carriers rated by AM Best. And the risk is if there's a really massive catastrophe, something that shakes confidence in the Florida market or stresses multiple Demotech-rated companies, you could see a flight to quality. Consumers, agents, maybe even lenders might suddenly prefer insurers with that top-tier AM Best rating. In that scenario, HCI could face a competitive disadvantage, even with its A from Demotech. It's a strategic choice balancing capital efficiency against perceived financial strength.
That's a really interesting nuance, highlights the strategic calculation involved in running an insurance company in such a unique market. Okay, let's dive into the numbers now, the financial performance. We've talked about this incredible turnaround, but let's see it in the data. It really is a tale of two distinct periods, isn't it? Before the reforms and after.
Absolutely. The financials starkly show the impact of that external Florida market environment on HCI's bottom line. Let's start with the struggle, the pre-reform years, say 2018 through 2022. This period was just marked by steadily worsening profitability. The company was fighting against that tide of litigation abuse we talked about.
How bad did it get for HCI specifically? What do the key metrics show?
It got pretty rough. Their combined ratio, that key profitability measure, lower is better, under 100 means profit. It just kept climbing. It hit an unprofitable 122.5% in 2022.
So for every dollar they took in as premium, they were paying out over $1.22 in claims and expenses.
Exactly. Bleeding money on the core insurance operation. And that resulted in a net loss for the year of $54.6 million. That works out to a loss of $6.24 per share.
Those are serious losses. And looking at the data table we have, gross premiums written actually peaked then at $775 million in 2022. But the loss ratio, just the claims part, soared to over 80%.
Yeah, writing more business just meant losing more money faster in that environment.
And return on equity cratered to negative 24.4%. Book value per share, which measures the company's net worth per share, dropped sharply from nearly $32 in 2021 down to just $18.75 in 2022. That really paints a picture of a company under severe financial strain.
It absolutely does. A very tough period. But then the reforms hit. And the turnaround financially was immediate and, frankly, profound. In 2023, just 1 year later, the combined ratio improved by more than 35 points.
35 points. Down to what?
Down to a very profitable 87.3%. And that huge swing drove net income to $89.3 million, a complete reversal from that $54 million loss the year before.
That is an incredible one-year swing. Shows the immediate power of those reforms. Did that momentum continue into 2024?
It absolutely did. And this is maybe even more impressive. In 2024, remember, Florida got hit by 3 hurricanes that made landfall: Debbie, Helene, and Milton.
Right, a busy season.
Even with those storm losses, HCI still managed to improve its combined ratio further, down to 83.1%. And net income grew again to $127.6 million.
So profitable even with 3 hurricanes hitting their main market. That really speaks volumes about the changed environment, doesn't it? The underlying business must be much stronger.
Exactly. It demonstrates that the legislative fixes created a more resilient model, one that could absorb typical catastrophe losses and still generate significant profit thanks to that better claims environment and the higher premium levels.
Looking at the 2024 numbers again, gross premiums written jumped way up to nearly $1.2 billion. The loss ratio improved dramatically to 55%. Expense ratio also came down. Diluted EPS hit $8.89. Book value recovered strongly to $43.41. And that return on equity went from deeply negative to a very impressive positive 32.5%. Just a remarkable recovery across the board.
Yeah, a return to really robust financial health.
And this momentum just kept building into 2025, I understand. It sounds like the first half of this year was even better.
That's right. With no major hurricanes hitting Florida in the first 6 months of 2025, the underlying profitability really shone through. In Q1, net income was $57 million, and the combined ratio was an excellent 66.9%.
Under 70% is fantastic.
It really is. And then Q2 was even better. Net income of $66.2 million, and the combined ratio improved further to an astonishingly low 62.0%. Their gross loss ratio for that quarter was just 21.3%.
21% loss ratio. That's incredibly low. It screams claims frequency way down.
It's a direct reflection of those reforms working, reducing the non-catastrophe claims noise significantly. And as you'd expect, this accelerating profit is having a huge impact on their equity base.
How so?
Well, book value per share jumped from $43.41 at the end of 2024 to $58.55 by the end of Q2 2025.
Over $15 increase in just 6 months.
Yep, over 34% growth in book value in half a year. That shows rapid value creation and the company getting financially much stronger very quickly.
That's incredibly fast growth in shareholder equity. So with all this cash flow and profit rolling in, how has management been handling it? What have they done with capital management?
They've been pretty active and strategic. A big move in 2025 was redeeming all their remaining convertible senior notes.
Getting rid of debt?
Exactly. That significantly deleveraged the balance sheet. Their debt-to-capital ratio dropped below 10%. And it cut their quarterly interest payments by more than 2/3. So cleaning up the balance sheet, reducing risk.
That makes sense. Strengthen the company while times are good. What about their cash position, their liquidity?
Also looking strong. At the end of Q2 2025, the holding company had over $250 million in liquidity. That gives them a really solid cushion and lots of flexibility for future opportunities or unexpected hits.
And despite focusing on strengthening the balance sheet, they still manage to return capital to shareholders. That's often a tricky balance.
They have, which points to a disciplined approach. HCI has a long track record here. They've paid a dividend for 46 straight quarters. That's consistency.
11 and a half years of dividends.
Yeah. Since they started, they've returned over $430 million to shareholders through dividends and also share buybacks. And they're still paying $1.40 quarterly dividend per share. So they're rewarding shareholders while also building that financial foundation.
Okay, we've seen the impressive turnaround, the strong financials. Now we have to look at the other side, the risks. Because even with all this good news, Florida insurance is inherently risky. What's the biggest, most obvious risk for HCI?
Yeah, you can't ignore the risks. And the biggest one, hands down, is catastrophe risk combined with their geographic concentration.
All their eggs in the Florida basket, basically.
Pretty much. Their business is almost entirely in Florida, a state that just gets hit by hurricanes repeatedly. A single massive storm, a Hurricane Andrew or Irma type event, or even just a string of smaller but damaging storms hitting populated areas in one season that could potentially blow through their reinsurance protection.
Exceed the limits.
Exactly. And if that happens, it could severely damage their capital base, their earnings, maybe even their solvency. It's the fundamental risk they live with every day.
And even with sophisticated computer models for hurricanes, those models aren't perfect, right? Nature can always throw a curveball.
Precisely. Models are not infallible. They buy reinsurance based on their modeled probable maximum loss, or PML, for, say, a 1 in 100-year storm. But storms can be stronger, take unexpected paths, stall over cities. Losses can always exceed what the models predicted.
So that outsized catastrophe event is always the elephant in the room. What about that regulatory and political risk we touched on earlier, the tension between profits and premiums?
That risk is very real and probably growing. Florida insurance is always under a political microscope, and that current situation ensures making record profits while homeowners are slammed with those huge premium increases that's politically explosive.
Yeah, Not a good look.
Not at all. So the risk is that politicians feel pressured to do something about affordability. That could mean rate caps, mandated rate rollbacks, maybe other regulations that squeeze insurer profitability. It could potentially unwind some of the benefits they just gained from the reforms. It's a constant sort of Damocles hanging over the market.
A delicate balance indeed. What about competition? We know new players are coming in attracted by the profits. How big a threat is that?
It's a significant threat to the level of profitability. Those supernormal profits HCI and others are enjoying now are acting like a beacon, drawing in new capital and new competitors.
Right.
That influx of competition will inevitably, over time, lead to increased price pressure. More companies fighting for the same policies usually means rates start to come down or at least stop going up so fast. So a key risk for HCI is whether they can maintain their market share and, more importantly, their underwriting discipline when the market gets more crowded and competitive. Can they avoid chasing bad business just to keep growing?
That's always the challenge in a softening market. And reinsurance, you said it's favorable now, but it's cyclical. So that risk hasn't gone away entirely.
Not at all. HCI relies heavily on reinsurance. While the market is buyer-friendly now, it can turn on a dime. A couple of really bad hurricane seasons globally or a massive earthquake somewhere that could cause reinsurers to pull back capital and hike prices again, just like they did in 2023.
Back to a hard market.
Exactly. And that would directly squeeze HCI's margins by increasing their biggest cost. They do try to manage the counterparty risk, the risk a reinsurer won't be able to pay by spreading their coverage across many different highly rated reinsurers, but the overall market pricing risk is always there.
Okay. What about execution risk? They're doing a lot, taking policies from citizens, banking on their tech, planning this Exio separation.
Yeah, there's definitely execution risk. Their strategy depends on doing several complex things well. They need to successfully underwrite and integrate all those policies coming from citizens, making sure they didn't accidentally pick up a lot of bad risks. Their proprietary tech needs to keep delivering those efficiency and underwriting advantages. And that potential separation of Exio needs to be handled smoothly and effectively to actually unlock value. If they stumble badly in any of those areas, it could hurt their growth and profits.
And lastly, just the standard risk for any insurer, their investment portfolio.
Right. That's always a factor. Insurers hold huge portfolios of bonds and stocks. If interest rates spike, the value of their existing bonds goes down. If the stock market tanks, their equity holdings lose value. These aren't specific to Florida, but they impact the overall financial health and capital position.
Okay, so a pretty comprehensive list of things to keep an eye on, balancing out the positive story. So let's try to bring this all together now with valuation. We have this compelling story, the turnaround, the tech, the risks. How is the market actually pricing HCI stock right now? What does the valuation tell us?
Well, it's interesting. HCI's valuation really looks like a company in transition. The stock price and its valuation multiples like price to earnings or price to book, they've definitely recovered from the depressed levels we saw back in the 2022 crisis.
Great.
But they still seem to reflect a pretty significant discount for the risks inherent in the Florida market, especially when you compare HCI to, say, specialty insurers operating in less risky, more diverse markets. So the big question for investors is whether the market will eventually give HCI more credit for its improved earnings power, or if that Florida discount is just permanent.
Okay, let's look at the peer comparison data. HCI's market cap is around $2.36 billion. Its trailing PE is 14.3, forward PE is a low 6.1, and price to book is 2.8. How does that compare to its direct Florida neighbors like Universal, UVE, and Heritage, HRTG?
Okay, compared to those direct Florida peers, HCI's trailing PE of 14.3 is actually higher. UVE is around 11.7, HRTG around 7.1.
Right.
But look at the forward PE based on expected earnings. HCI's 6.1 is similar to Heritage's 6.1 and quite a bit lower than Universal's 8.7.
What does that suggest?
It suggests analysts are forecasting really strong near-term earnings growth for HCI, potentially stronger than for Universal. Now look at price to book. HCI's 2.8 is noticeably higher than UVE's 1.6 and HRTG's 2.0.
Why the higher price to book multiple for HCI?
It likely reflects a few things. HCI's recent profitability and return on equity have been superior. The market might also be giving them some credit for that potential value unlock from spinning off Exio, maybe a perception of better management execution too.
So relative to its immediate Florida peers, HCI looks pretty well valued, maybe even richly valued on some metrics like price to book. But then you compare it to a high-quality specialty insurer outside Florida, like Kinsale Capital, KNSL.
And the picture changes completely. It's like night and day.
Kinsale has a market cap over $10 billion. What are its multiples like?
Kinsale trades at a PE around 25 and a price to book of almost 6.
Wow. So HCI, UVE, Heritage, all the Florida guys are trading at a massive discount to Kinsale across the board.
Huge discount. And that's the crux of it.
So why? Why does the market value Kinsale so much more highly than even the best performing Florida insurer right now?
It boils down to perceived risk and earnings quality. The market sees Florida homeowners insurance as inherently much riskier and more volatile than Kinsale's business. Kinsale operates in niche specialty insurance lines, excess and surplus across many states. They're diversified.
Not concentrated in one hurricane-prone state.
Exactly. Their business isn't as exposed to single huge catastrophe events, and it's generally less subject to the intense political and regulatory pressures you see in Florida. The market pays a big premium for that perceived stability, diversification, and lower catastrophe risk.
That makes total sense. It's the diversification and lower cat risk premium. What about HCI's valuation historically? Is 2.8 times book value high or low for them?
Well, their valuation has swung wildly over the years with their profits. PE isn't great for comparison because they had losses, but price to book gives a better picture.
Yeah.
The current 2.8x is way up from the crisis low around 2.0x in 2022. It's also above their 10-year average.
But is it near previous peaks?
Not quite. It's still below the levels it reached during prior profitable cycles when optimism was maybe higher. So significant recovery, but maybe not peak valuation yet.
Okay. So what would it take for HCI's valuation multiple to expand further? To maybe close some of that gap with the Kinsales of the world, or at least get back to its own prior peaks? What are the key drivers?
It all comes down to the market believing the earnings are sustainable. That's the magic word.
Sustainability.
If HCI can keep putting up strong underwriting results, high ROE, not just when the weather is calm, but crucially through a major hurricane season and while fighting off new competition, then investors might start to believe that this post-reform profitability is more durable, less volatile than before.
So proving it's not just a temporary windfall.
Exactly. And of course, a successful value-enhancing separation of Exio would be a huge catalyst. If the market suddenly sees a valuable tech company sitting there separately, that could absolutely drive a re-rating of the whole HCI structure. It's all about building investor confidence in the long-term story in a market known for booms and busts.
Okay, let's pull all these threads together. We've covered a lot of ground. What's the bottom line for you, our listener, as we synthesize the bull case and the bear case for HCI Group?
Well, connecting it all, HCI is clearly a prime example of a company riding a powerful positive wave in its core market. Those legislative reforms were a game changer for Florida insurers, and HCI has capitalized incredibly well. They've turned strong premium growth into really exceptional underwriting profits.
And manage their capital well, too, it sounds like.
Yes, management deserves credit there. Strengthening the balance sheet, paying down debt while still rewarding shareholders, that's a solid foundation. That's the bull case, really. Reformed market, strong execution, smart capital management.
Okay, that's the bull case. But the central question, the elephant in the room, has to be sustainability, right? Is this amazing profitability the new normal or just a peak?
That is absolutely the core debate. And the honest assessment suggests that while the reforms definitely created a much healthier baseline, the kind of profitability we saw in 2024 and early 2025, that's likely a cyclical peak. It probably won't stay that good forever.
So the key going forward is?
The key is whether HCI's own strengths, particularly its technology, can help it maintain strong underwriting discipline even as competition heats up and inevitably pushes prices down market-wide. Can they build a truly durable competitive advantage, or were they just benefiting most from the initial post-reform gold rush?
So it's about their internal moat versus the external tide turning again. How have they handled the other big risks, like storms and reinsurance?
Well, so far so good, really. They navigated the recent hurricanes effectively from a financial standpoint. They secured their latest reinsurance program in a better market. They've cut their debt way down. These are all positive steps in managing risk, but
There's always a but in Florida insurance.
the primary unmitigated risk is still that massive hurricane, the one that swamps the models and the reinsurance. That unpredictable natural disaster risk never goes away.
And the regulatory risk, that affordability tension, still lurking.
You're lurking, absolutely. Near term, things like stable, regulators probably want the reforms to settle. But medium to long term, that tension between high insurer profits and painful homeowner premiums, is a political wildcard. It could definitely lead to unfavorable rule changes down the line if affordability stays a major issue.
Okay, so wrapping it up, the whole discussion around HCI really boils down to the duration of this favorable period. How long can these good times last? And are HCI's internal strengths, their tech, their management, their capital strategy strong enough to build a lasting advantage that can ride out the inevitable return of tougher competition and market cycles? It's a really finely balanced picture.
Exactly. What could drive the valuation higher? Continued strong underwriting, especially through a tough storm season, a successful Exeo spinoff that unlocks value, proof they can defend market share profitably. What could drive it lower? A huge hurricane loss, faster than expected price competition, or negative regulatory changes. It's definitely a dynamic situation investors need to watch closely.
Wow, what a deep dive that was. From an industry on the brink of collapse to record profits, all seen through the story of HCI Group. We've really seen the power of specific laws to reshape a market, the hidden influence of global reinsurance cycles, and how one company uses tech and strategy to navigate such a volatile place.
It really underscores how policy, economics, and business strategy are all deeply intertwined. You can't understand one without the others, especially in a market like Florida.
So for you, our listener, thinking about the key takeaways, remember just how potent legislative change can be. Remember the cycles, both local market cycles and those global reinsurance waves. Think about how unique company assets like tech and experienced leaders who have skin in the game can make a real difference.
And crucially, never forget the risks that persist. That geographic concentration, the affordability tension, and the ever-present threat of that next big storm. They're always part of the Florida insurance equation.
Absolutely. So as you mull over all these complex dynamics, here's a final thought, something to chew on. Given how cyclical we know the Florida market and the global reinsurance business are, how do you really tell the difference between a temporary peak in profits, like maybe what we're seeing now, and a truly fundamental lasting shift in how the industry works? What evidence would you need to see to be convinced that this current stability is built to last, and not just the quiet before the inevitable next storm? It's a tough question, but central to understanding any market prone to booms and busts.